Good, good morning, everybody, and welcome to this webinar hosted by the Employee Ownership Association. This is, as the title says, an introduction to employee ownership. So the purpose of the webinar this morning is about explaining the key principles that an organisation thinking about employee ownership needs to consider. So as the leading organisation in the UK for employee ownership, we've put this webinar together to help businesses understand more about EO. We're delighted to be joined by our speakers today from a legal firm called Brabners. Stephen Hadlow will be with us. We've got a case study from a company called Boardman Brothers about becoming employee-owned and that transition and the key points that they went through. And also we're joined by Mike Donnell, who's the Regional Director of ThinkCats. ThinkCats are a business that can help with accessing finance about becoming employee-owned, but also once you are employee-owned as well. I'm going to say a few words about the role of the EOA and how we can support you as a business thinking about employee ownership, or if you've recently become employee owned as well. And you're going to get an opportunity to ask questions of our speakers today. You can ask those questions virtually by using the chat function to the right-hand side there. So you post your question, and then what we'll do, you can upvote them as well. So we will ask the most popular ones to our presenters. And then afterwards as well, you're going to get the opportunity to meet those presenters yourselves in our virtual lounge, where they'll be sat on tables. So you'll either ask questions of them, you'll be able to move around and talk to one another as well if you wish to do so. So what I'm going to do now is introduce you to our first speaker, who is Stephen Hadlow from Brabners law firm. Stephen can tell you more detail, but in summary, Brabners have been a member of the EOA for a number of years now. They've supported numerous organisations to become employee-owned. So we certainly feel that Stephen's in particular, his expertise and insight will be really invaluable to you as you consider if employee ownership is a viable model for your organisation. So if Stephen can join us on stage. Morning, Stephen. If I could hand
you. Thank you. That's worked quite well. Morning, everybody. As Oliver said, we at Brabners advise lots of businesses on transitioning to becoming employee-owned, and also once they are employee-owned. It's quite a wide topic to talk about, introduction to employee ownership. So this morning I'm going to focus on three things in particular. The first thing are some of the key questions you want to perhaps look at when you're transitioning to becoming an EOB. We're then going to look at some of the structures and models of employee-owned businesses and demonstrate the flexibility of the model. And then we're going to have a little chat about governance towards the end as well. So first of all, key questions when planning an EOB transition. I've distilled these into 6 areas. The first one is, do we have the right culture to adapt easily to an EOB model? I've said there, evolution, not revolution. And in actual fact, I think there's no doubt that businesses which value their people and have an open engagement with staff will find it much easier to move to an employee-owned model. In fact, for many businesses, that's possibly the reason why they look at employee ownership in the first place, because they want to protect that culture. And I think the key thing to say that it's actually therefore far more straightforward for those kind of enlightened businesses than it is for businesses that have to, reimagine their culture. And certainly at the other end of the scale, for owners that focusing solely on non-cultural reasons, possibly solely tax reasons, they will find that very much more challenging to transition to an employee ownership model than those businesses that already have an open and enlightened culture. Is the business profitable? Is absolutely critical. There is no magic money tree. This is a transaction which is funded through the business's viability and profitability, whether that's funded by way of vendor loan or whether external funding is used, as Mike will come on to later. The business will always need to be profitable. And unless cash is lent directly to the trustee, then generally it is the net worth of the business that will dictate how much cash can be funded, both on day one and also going forward. So if there are deferred instalments of the purchase price to pay going forward, then those instalments are absolutely linked to the business's ongoing profitability. Will the company valuation match owners' expectations, and are they prepared to wait to be paid out? So it's important that the fair market value of the company, as set out in an independent valuation report, gives the shareholders, the owners, the return that they're looking for. So if an owner feels that there is a significant premium to selling to a trade buyer for strategic reasons which may be difficult to quantify, then maybe a trade seller can financially provide a better deal than selling to an EOT if financial reasons are a big consideration. The other consideration, of course, is that it will probably take longer to pay out the consideration, the purchase price for an EOT transaction than it may do for other kinds of transactions. That can be mitigated to some extent by taking on external finance, but generally, it can be a 5 to 10 year period before which the owners get paid out in full. So again, that has to be taken on board when looking at these transactions. Is there a leadership succession plan in place? Is really, really important. A management buyout to trade sale may solve that, but that is not necessarily solved by an EOT transaction. Particularly where the business owner sits on the board and runs the company day to day, then if they are looking to retire, and if this is a succession plan where they're looking to step away from the business, then it's critical that they identify the right people in their business to step up to be able to run the business going forward. That's particularly important, of course, if an external funder is relying on the business to continue to be able to service that debt, or indeed if there's vendor loans and the owners themselves are relying on a new leadership team to run the business effectively and profitably to allow those deferred payments to be made on time. Do we have the right advisors on board? Well, obviously I have some self-interest in this, but I do think it's important to talk about. It's important that that when you come to be employee owned, you understand what that means, what is involved in the steps, and therefore good advisors are key to that. I'd also suggest that that anyone looking to become employee owned, or anyone that's become recently employee owned, joins the EOA. Again, there's a large network of businesses that can support, provide advice. All that is really, really important. It's not a transaction that can be done merely on paper. It's important to have advisors that explain and talk you through the journey to being employee owned and what is involved from A to Z, really. Do we have a plan to bring our people with us along our unique EO journey? So again, it's all part of planning. How you do that is how you speak to your staff if you're looking to become employee owned is for you to decide. However, it's important that you do make a decision on how to do that. In other words, there's no point becoming employee owned if the people in your business don't understand what that means, don't understand how the business is going to evolve, what the future looks like, and don't understand the benefits of being employee owned, because that defeats the object to some extent of becoming employee owned if the staff don't get a sense of what that means to be in an employee owned business. So I think that's absolutely critical. There are lots of other things to think about, but I've tried to cover 6 key areas there in that slide. So then, talking about the structures of an employee ownership model, and really wanted to sort of stress the flexibility of employee ownership that many people think is not, it's not inherent to employee ownership, that it's actually quite rigid. In fact, I think it's quite a flexible model, and there are lots of different types of employee-owned businesses out there, all having EOTs, by the way. So probably the most straightforward model is the one in front of you, which is where the owners owning 100% of the trading company sell 100% to the trustee, and that's a a very common model, and one which we see a lot of, and what you call possibly a pure EOT transaction, where the owners achieve a full exit, and the business is 100% owned by the trustee. It's also possible in the next model for the founders to sell less than 100%. It's only a requirement that the trustee holds a majority of the shares in the company. So there is potentially up to 49% of the shares which can be retained, and that might be for various reasons. It might be because the founders want to retain a legacy shareholding to pass on to future generations. It might be that they are interested in a dividend stream that could be achieved from retaining some shares going forward. It may be that in order to structure the transaction, to reduce the price of the deal, it's necessary to reduce the number of shares being sold in order to make that transaction viable from a financial point of view. The next model is more and more common with transactions, and we see this more and more as a part of EO transactions that we work on, and that is where 100% of the shares are sold, but shortly after the business has become employee owned and transitioned, then new shares or share options are issued to new management, and that's commonly through what's called an EMI share scheme. And that's important because it gives your new leadership team some skin in the game. It gives them a sense of their own ability to achieve some capital growth by holding shares directly. That it's also important from an external funder's point of view, potentially, or from the owner's point of view, to make sure that having very incentivized management encourages the businesses to perform well, which encourages the ability of the business to pay off the deferred installments or to service the external debt. So again, that can be a key part of allowing the business to push on. There are some consequences for management holding more than 5% of the shares in relation to their relationship with the trust, but as I say, generally that's quite a common feature now of employee ownership transactions, that some form of share option scheme is provided after the transactions happened. And then finally, I've got an example there with as much as I could think of to throw in, really. So I've put some numbers in there. So the EOT holds 60% of the shares. The founders have held 15% back, so they keep a 15% stake. There's a share incentive scheme where new management hold 5%, and then the new feature there is this introduction of patient capital, which there are providers in the market who will fund transactions by taking equity. It's sort of model which sits well with standard private equity or venture capital, but there are specific funders out there that have a patient capital model, and they will effectively look to receive a return on their equity aligned with profit bonuses being paid to employees. So that's just one example where you could have quite a diverse share ownership and still be a qualifying employee ownership trust. Okay, so I mentioned governance earlier. For all these models, governance is key. It's key in relation to the trustee board. The trustee board needs to be, just pop that up, Laura. The trustee board needs to be a balanced board and an independent board. So we would typically recommend that it has at least one independent voice on the board, it has at least one employee representative on the board, and that it's not controlled by board members sitting on the trading company, that it has proper independence. It's important that the trustee board understand what they're there for, that they have clarity as to when they meet, what their role is. They have an oversight role. This can be overlooked. Sometimes the trustee board misunderstands their role and believe that they're there to run the company, which they're not. The trading company board is there very much to run the company, and so having those lines of those sort of areas of involvement are key to sort of demarcate what does the trustee board do and what does the trading board do. That's really, really important, having that clarity. And then also governance for the company, for the business, because obviously it's now an employee-owned business. So it's important to formally recognise the principles which the company is being run under, principles of employee ownership and what that means, and how the company should therefore carry on its day-to-day business as an employee-owned company. The governance structure for the company can also provide formal oversight provisions for the trustee, as we've discussed, but it can also provide some oversight provisions for the former owners. If they are owed deferred instalments, they can effectively have some levers to pull on the business and some oversight on the business. They may well carry on as board directors and have it through their continuing seat on the trading board. But if they were to no longer be on the trading board, then having some other form of ability to see what's going on in the business, to get financial information, for example, potentially to have some vetoes over strategic decision making. Those are all part of the mix of the governance that we would always recommend should be included. So I think that's my 10 minutes just about up. That's a quick run through. As Oliver has said, I'll be on the tables later to pick up any specific questions you may have, and also to answer those in the Q&A section later. Thank you very much.
Fantastic. Thank you, Stephen. A few key words I picked up there, definitely one around flexibility. But you mentioned planning and you mentioned the word journey quite often. So it seamlessly, we link now to Philip Wright from Boardman Brothers. So Philip's going to bring to life the journey that business went through in order to become employee owned, and demonstrate and explain to you the structure that they adopted and how that process was put into practice. So Philip, if I can hand over to you, please.
Thank you, Ollie, and good morning all. We're also joined on this presentation by a colleague of mine, Amy Smith, who's going to take up one of the tables at the end. So not only will you hear from me as the seller and ongoing CEO of the business, but you can also hear the real version from Amy as both an employee and a trustee director. But to whiz through our story, Boardman's background is it's a long history, incorporated in 1925. The Boardman brothers did, in fact, start it. Another family took it over. And then I led an MBO in 2005. And that experience probably shaped some of my reasoning for going down the EO route. But I wasn't aware of EOTs until 2018. And I joined the EOA, which I have to say was a fantastic thing to have done at the time. In 2019, of course, we could still have live events. And I went to a number of regional and national events, which helped inform my decisions and the route we went. Having had a valuation in 2019, of course, the transaction didn't happen in 2020 as planned, obvious reasons. But we did go on to complete in October 2021. We've just celebrated our first anniversary. So why employee ownership? We had offers for the business over the time I'd been involved in the MBO, and I felt it would jeopardize the future of the employees. Simple as that. Companies take over, people are removed, key people don't always end up happy. We have 3 kids, and happily they've got real jobs rather than ones relying on me and mum and their own career plans. So that wasn't an option either. And as I said earlier, my experience of the MBO was shaping my ideas here. And the MD we had employed at the time wasn't interested in leading an MBO for whatever reason. So the EO route happened to complement our very open and transparent culture, where we historically shared information, financial information on a quarterly basis, involved people as much as we could, had very good engagement figures, and as was often said, Boardmans is and was a great fun place to work. So I had a great culture, as was referred to by Stephen before. Oh yeah, and it does save a load of tax, obviously, but that's not the main reason, I promise you. So our model is a simple one. We went for a sale of 100% of the equity to be held in trust for the employees. And why 100%? Well, the MD I mentioned, who didn't want to lead an MBO, he decided to actually leave the business just prior to the transaction happening. We had planned for and set up an EMI scheme ready to roll post-sale, so that we would sell 100% of the equity to the trust, and an EMI scheme would be in place for him and potentially other senior managers in the future. He didn't stay with the company, but I felt that the 100% equity route for us was the right model in terms of going whole hog. Wanted the employees to benefit full-heartedly from that. There is still the option for an EMI scheme in there. I think that's going to be important for the longevity of the business to offer attractive incentives if we need to bring in the right people or to keep the right people we already have. We have a board, of course, an EOT board, the trustees, and they sit above the management team only in terms of ownership of the shares and representing the beneficiaries. They do not run the company. I'm a trustee. I was the first trustee, as the paperwork sort of dictates almost. We have an independent trustee, and we also have Amy, as I said, who's on this call, who is our employee representative trustee, and she was voted onto the board. And that, I think, was fantastic. She was able to do training through the EOA on how to be a trustee, how to get the best out of it, how to understand finance, and a lot of other aspects of becoming a trustee. I do hope you'll ask her, as I say, the real version of what I'm saying later on. But how do you finance a transaction? We have been a very prudent business, and we've retained profits and built up a reasonable balance sheet. And we were able to, once we had the valuation and clearance from HMRC, which is probably the thing that takes the longest in the whole process, because the legal and accountancy side of things can be done quite swiftly, as we were effectively both buyer and seller, my wife and I. And we had sufficient reserves to pay 50% out from the company on day one, and the balance is deferred, scheduled to be over 5 years in equal instalments. There are penalties if it's late, and obviously it's in everyone's interest, especially the beneficiaries, the employees, for it to be paid earlier. So, but that's our simple model of financing. The way you communicate an EO transaction is very varied. And I've heard of people telling you to share the story and involve the employees and what's going to happen ahead of it going down this route. That's not what we did. Despite being really open and transparent as a business, it's still a confidential transaction in my view. So we treated it as if it was a trade sale. And in a trade sale, people sign NDAs, and you don't go around shouting about it. So apart from the then MD, our financial controller, who of course was involved in getting the numbers organised and so on, the only other people to know were the advisors and my family members. So we got right to the 11th hour of having everything agreed and in place, and just a day or two before completing the transaction, we shared with the management team what was going to happen. We told them that later that week, the business was going to be sold. And of course, there were a lot of questions that came out from that. Many of them very, very positive, I'm happy to say, and gave them a little bit of time for that to settle in. The transaction completed on a Thursday. my wife and I went out and celebrated. And then the following Monday, we then did a presentation to all the employees. And in that, we tabled a number of questions that they should ask, but frankly don't think about at the time. And if anyone wants to get in contact afterwards, I'm happy to share more about that. But really understanding what people's concerns may have been, what their reservations are, their worries, and also explaining what the upside. It was trying to do all the work of the thinking for them. And I think that kind of preparation lays the groundwork. But it doesn't mean that people get it from day one. Definitely not. And we'll cover that a little bit. We also put in place and announced at that day one presentation that we would put an EO bonus scheme in place. We'd historically paid profit share bonuses to our employees anyway. So it was along those kind of lines based on hitting certain EBITDA performance targets in our case. And we set a slightly arbitrarily low threshold to make sure that we did pay out a bonus early on to signal to everybody that we'd moved, there was profit being shared, and that profit shared bonus, obviously up to £3,600, is paid tax-free. So it sort of really signaled and underlined the transaction. But other than that, the management of the business didn't really change. The trustee's role isn't to run the business. It is the management team. And whilst I am a trustee and I'm on the management team currently, I have to wear two hats. The independent trustee, our employee trustee, they are not part of the day-to-day running. And we put in place a very limited number of conditions where the management team needed to go to the trustees for permission, which were largely around exceptional expenditure outside of budget for capital or serious recruitment levels. We want to leave the management team as trustees to focus on making the right commercial decisions, which they were doing before the transaction, post it, and build on financial success as before. And my role now, whilst I'm more involved than I planned to be because the MD did leave, my role primarily, I see, is to support the succession and the development of that team to ensure that the business continues to thrive. If I'm running the business day to day and if I'm involved in every single thing, that management team isn't going to deliver my deferred consideration. It isn't going to deliver the growth of the company, and it isn't going to be truly employee owned in my view. So top tip, if you're thinking of, and you're a founder or an owner, plan to get out quickly. I work officially 3 days a week now, and I'm only in the office 2 of those regularly. The other change is racing through this, because I know we are tight on time. My wife and I were the directors of the company. We needed to appoint somebody else, so the financial controller, who was trusted with knowledge prior to the sale, she became a director of the trading companies. We have an employee council set up as well, which happened to think about 3 months after the transaction completed, after we'd had a chance to get everyone used to the idea, and people were putting themselves forward and voted on to this council, this forum, and they feed back ideas to senior management. Straight away after they met, they ran an engagement survey. They got together a new suggestion scheme, and I'll be honest, most of the suggestions that came back from employees at first were, what can the company do for me, rather than what I can now do for the company as an owner. Like, can we have a new freezer for ice creams in the summer? We didn't buy one, but you know, in Manchester, it's not that summery all the time. But that feedback from employees through the council means that individuals aren't having to go to a manager and speak in that way. They're going to their peers and say, no, what about this? Is this a crazy idea? Can we? Should we? And that's a key part of flowing through and a key part of employee engagement. Over time, whilst myself and the financial controller are the directors of the company, the trustees, like any other shareholder, would appoint directors. And our plan is for me to move off the management team board and to appoint other directors to run the business. But we've only just celebrated our first year anniversary. I'm very pleased to say I've got my first year's deferred consideration bang on time. And we are looking forward to, whilst difficult trading times, a business I think is genuinely more resilient because people are working for themselves. They are working for their own interests in the long term. And I think it's given Boardmans the best chance of survival in a very, very tricky environment. Thank you.
Phil, fantastic. Thank you very much. Thank you for sharing the journey and bringing that to life for us in a very summarised version. That's got to be said. Now, I'm going to move us on towards Mike Donnell, who, as I mentioned, is Regional Director at ThinkCats. ThinkCats are a member of the Employee Ownership Association, and the reason they're with us is because they can provide insight and access to finance that's required for the move to employee ownership, but also afterwards as well. So I'm delighted to welcome Mike, who's going to explain a little bit more, and we'll take some questions afterwards. Over to you, Mike.
Yeah, so morning, everyone. Firstly, thanks to EOA for asking ThinkCats to join the webinar today. We're keen to get engaged with business owners, vendors, and or potential EOT teams as early as possible. Just to give you a quick background of who ThinkCats are, we're an alternative lender. We exist because essentially we fill a gap where I believe obviously the big banks are not funding, and an EOT is a good example of that. You know, we hear a lot that businesses do not approach the bank anymore because they don't particularly always like the change of ownership into EOT. We're different. We exist for those reasons. We fund all sorts of transactions, not just EOT, and we fund growth, refinance in every way to businesses. So we just see EOT as another alternative, as a transition of your business, and that's why we like EOT. So just to touch on the first slide there, you know, the common obstacle being that actually it's a change of ownership to any lender that's a risk. You know, what's going to happen after a transaction? Well, key for us is to understand that, really understand if EOT is the right thing for this business. If it is, often we can support that. And what does funding do? It provides an alternative. So great, if the transition can be funded without funding, it's everything. It's like everything in life. If you can buy a house outright or you can buy your car outright without borrowing money, then great. But what actual funding does, it's an accelerator in life. So it's the same with buying a business, or you know, we can help and provide a range of alternative options, both to vendors, but also help EOT teams after the event to help grow their business as well. So we want to be on that journey, and normally if we can get involved at an early stage, that's really important, and we believe we can add value. So going back to, or referencing Brabners' slides earlier, and Stephen pointed out some real highlights and real considerations. Virtually verbatim, we would echo everything that Brabners have put in there, and you know, we would work with good advice like that alongside you, and again support the transaction. So you know, good advice is key, and again we can help guide. For us, the clear benefits to EOT teams is that we can bring both parties together. So we would always encourage transparency. So we wouldn't want to be just speaking to the vendors. We would want to be speaking to the EOT team as well. So we would possibly be real help in that, because actually we would add alternatives which could actually change the transaction for the benefit of both, and we can show examples of that. So again, funding being that option, it's not just about providing funding to a business. Actually, we can give real alternatives and help escalate some tough decisions, and show examples of how we can fund and structure in that as well. So early engagement is key. But again, going back to again what Stephen touched on is some of the critical points that we would look at is the business profitable? Can it show it's got a sustainable, viable model? What's the growth strategy? Really key is who's managing this business. You know, we back management teams. We want to back a team that is got good controls, good forward visibility. But again, is EOT right for this business? If it's not, we won't be funding it. You know, it's as simple as that. So we're worth a sounding block at least to say this is not one for us and the reasons why. Sometimes actually that opens a couple of people's eyes, but actually in terms of generally EOT, if you're already on that journey to transition, we will want to support that. Just referencing what Philip was saying there, I think Philip would endorse that if he understood that funding was an option, I'm pretty sure we'd have had some real early engagement with Boardmans pre-EOT. But again, we don't always fund EOT pre-transaction. Sometimes we get involved with an EOT after they've done their EOT. Because again, ultimately what we're trying to do here is fund a business and help them grow. And so we're not just about funding the transaction, it's also to understand where this business is going to go ahead for the next 3, 5, 10 years. But yeah, so we are a funding partner for the full journey, not just the EOT transaction. So keep that in mind. And what we do is we structure debt accordingly. So we would look at your numbers. We would ask you to project where the business is going to be going. And, you know, within our gift, we can structure debt in so many different ways. One thing we won't do is overlay the business with too much debt, especially in this interest rate environment. We can structure our debt to support, you know, whatever your cash flow, free cash flow in the business is supporting, because fundamentally that's what we lend against. We're not looking for alternative security. We're not going to ask for personal guarantees. We lend against the viability of the business and its ability to generate cash flow. And it's that cash flow that services our loan. It's as simple as that. So removing any black art of what a funder does and why we're so special, there isn't such a thing. Quite simply, we back a management team and we back a business to help them on their growth journey. So in simple terms, that is a funder, but actually that's how we approach it. And anyone that wants to have any early engagement discussions with me, please do. And we would like to talk to you early as possible. That's me.
Fantastic. Thank you very much, Mike. Appreciate the insight to that, and you know that opportunity of questions that's going to come next after when we do a Q&A with everybody in our virtual lounge. Right. So the next bit is about the Employee Ownership Association. So the EOA, as we're known, we are the leading organisation for employee ownership in the UK. What we are is basically the representative body. This is our purpose. This is our vision. It's about unlocking the potential of business. It's about recognising the opportunity of employee ownership and what that can create. And nowadays, in 2022, in an economy where people are looking at alternative forms of doing business, we really see employee ownership at the forefront and at the core of that. Hence, the significant growth that we've seen in the sector, which is demonstrated on the next slide that's coming through here. Now, these stats they are about 6 months old, but it demonstrates, especially that to the right-hand side, the growth that we've seen over the past few years since the inception of the EOT back in 2014. And that's basically come about through businesses like Boardmans, through advisors like Brabners and ThinCats, creating the awareness and creating the understanding to have businesses like yours thinking about employee ownership from the start. So record year in 2021, and we estimate now, I mean, it's saying 1,030 businesses. That was in June earlier on this year. Well, I would say we'll be over 1,100 already, and that's just going to grow and grow and grow because of the needs and wants we feel of the economy in this year and going forward as well. So on the next slide, you'll see what we would refer to as a good journey towards employee ownership. So how a business should go about exploring that transition. And the first stage is around discovery and exploration, because as has been alluded here, it's potentially not for everybody. So go about your research first of all, and do that effectively by what we say speaking to other people. And this journey, this roadmap that's on the screen right now basically alludes to that, and quite how the EOA can help you with it. So we host a number of events virtually over the past couple of years, but also physically as well. We just last month had an annual conference for 650 people. So we have virtual events, in person, and we use our network of over 650 businesses to connect you with others that have been there and done that, just like Phil, for example. So they share their stories. You get a great deal of learning and experience. And alongside that, we have, within our next slide, if we could please, you can see that we help with learning. So there's facilitated introductions. You can grow your network through our online platform. And also we have a learning program that enables you to understand, for example, the role of an employee trustee. How do I capture employee voice from the team in order to bring employee ownership to life? And also, what do I need to do for my leaders of the organization, the next generation of leaders? How can they step up and be upskilled in that role as well? And as I alluded to, the events that we do encompass everything around networking and learning. So the EOA is positioned really as the go-to place for employee ownership in the UK, hence why we're hosting this webinar. So if you've got any questions, please save them for the members of the team that will be on the tables afterwards in the networking lounge. And also we naturally will follow up with you all after this webinar as well. So if I've quickly gone through what the EOA's role in the sector is, if we could invite the speakers back to the stage, that would be fantastic, because I'm aware there are a whole host of questions that you've all been posting. And please feel free to continue to post. Feel free to upvote the questions that are already on there that you like. And what I'm going to do now is do my best is get through as many of these questions as possible. However, I'm not going to promise to do that, but you'll be able to ask some of these questions that don't get asked in the networking lounge afterwards as well. So the first question, and gents, feel free to raise your hand and chip in as to who would like to take it. But I'm going to come to you first, Stephen, if you don't mind, on the most popular question. What happens if the business starts to fail once fully employee owned by the trust?
Okay. By saying that there is flexibility built into the transaction in relation to, how the deferred instalments are paid, and that's supposing there's not a bank debt in place. Mike can talk about what banks might do, but in terms of there being a vendor loan in place, then the vendor effectively is relying on the trustee receiving cash from the company, and the company can only make that gift of cash if it has made profits. And so there's a direct connection between how the sellers get paid and how well the business is doing. Quite often businesses do overpay because they're doing better than expected. But if the business is struggling, then ultimately the vendors will have to understand that they will need to be more patient to receive the rest of their deferred instalments. And then I suppose I can't avoid but saying, there is no magic money tree. As I said, if the business completely fails before the deferred consideration has been paid out, then there's no getting out of it. That there's nowhere else to go to. There's no third party magic guarantor that will pay up the balance. Now, I think companies, on the basis that the business is not going through a big change, most business owners feel that is a comfortable risk they can take, because they can manage any change that there is in the business themselves. There's no third party coming in to upset the apple cart, and therefore that generally, if the business were to fail, it would be due to possibly external economic headwinds or other factors they can't control. So that's generally why most owners feel comfortable about that.
It goes to your point about risk and feasibility, Stephen, from the start. If a business were to fail due to becoming employee owned, then really wouldn't have gone on that journey in the first place. And outside factors may affect it. But Phil, additional comment?
I would add that the management teams, I said in my piece, are there to run the business. Because it's employee owned, it doesn't make it a soft touch. Managers have got to make harsh decisions. And if redundancies need to happen, if there's restructuring, the business should be run commercially in exactly the same way, whoever owned it, and tough decisions will be there. And it might feel harder because employees are affected, but that's a harsh reality. But I do agree with Stephen. I think the statistics bear up traditionally that employee-owned businesses have a better survival rate, and I certainly believe that our employees are the best placed to make it survive.
Thanks. And Mike, you also popped your hand up.
Yeah, it's a great opening question. Firstly, apologies because I think my video is out of sync again with my audio. But what you've got to understand is what we do is we will only be lending to a business if it's viable. And we do that testing before we lend a penny. So for anything, at least we are a good sounding block to actually look at whatever this business is taking on, whether it's vendor loan or it's third-party loan. Somebody should be checking that, and normally a good advisor like a Brabners should be giving you that good level of advice to say this is the right structure for the business going forward. So, but we do that as part of our funding structure, and things do go wrong. And so it echoes what I'm trying to say about being on the journey is you need the right funding partner, like you would expect a bank to do or any bond. You especially need that with an EOT, because one of the options to support a business when it goes wrong is the owners put back in. They can put equity back in. In an EOT, that's probably not going to happen. You know, you generally can't go to all the shareholders and say, can you equally all put in the same amount of money? It's not going to happen. So we understand that. And so we recognize when we're entering into an EOT transaction to fund it, is that we are fundamentally going to need to support this business on its journey. And when things go wrong, because they do, not all the time, but when they do, it's up to us to be engaged early and have an understanding of that business, and we can support. So we don't just support transactions, we fund growth, and we also can refinance and restructure. And that's not what we aim to do. We want to put the right funding in place from the outset that gives good headroom to support the business. But when it does start to go away from the original strategy, we're also there on that journey.
Great. Thanks, Mike. What we're going to do, I'm going to fire questions at you, given the volume that keep coming through, gents. So the next one, and the most popular, are the suggested documents defining the role of the trustees? I'm going to take that one. The answer is yes. Legal advisors can provide some insight into the role, but also the EOA has a host of documents, and also we have a training program that enables people to understand what the role is. And it's really important that you get the right people as trustees as well, which is alluded to about your governance. Employees shouldn't be voted based on a popularity contest. It should be around having the skills and the competencies to do the role. And the same thing applies with your independent trustee. Next question: if there are trade buyers prepared to pay, say, a 10 times multiple that is the valuation, would that be used for an EO sale, or would that be different, Mike?
Yeah, a big question is what's the business value? What's the transaction value? Largely in an EOT, it's decided by the people who are selling the business. It's like anything in life. Normally you would have, when you're buying a house, you have the purchase price is based upon what is both the seller and the vendor willing to pay or sell for. So in an EOT, often that is driven by the vendor. Let's be very honest. It's normally a price, and that price is driven by a number of factors, but largely what is someone else willing to pay for this business? And a trade buyer is often a good barometer. And there's all benchmarks out there already from our perspective. And again, you speak to good advice on your journey, you'll understand what that range is. But we will look at that range as well, and if we believe the price is out of kilter, we would flag that.
Yeah, got to be independent. It's got to be fair. Yes, Stephen?
Yeah, I just say, it's important that businesses are not overvalued. That could potentially cause the revenue possibly to question the transaction, to question the commerciality of the transaction. If there's one particular buyer that is paying more than anyone else, because as I said in my earlier, if there's a strong strategic reason why that target company works for that buyer, then maybe that's not the best barometer for what is a true value of the business. But if 10 times multiple is the right multiple for your sector, then that might be perfectly viable.
Thank you. Next question is for you, Stephen. I'll keep you on. Can an EMI scheme be introduced for the key people retrospectively?
No.
Thank you. Stephen's available on afterwards if you want to find out.
Sorry, that was a bit short, but I can.
No, I asked for short, so that's perfect, yeah. Stephen. Thank you. Next one. What is the typical time scale for successfully completing an EOT process? Great question. Phil, shall I bring you in just to explain your time scale, start to finish?
I'm not sure I'm the best to answer the typical one. I can tell you that it can be very short, a matter of months. HMRC clearance can take however long they take, and I guess that's a lengthening piece of string at the moment. But it's an internal transaction, effectively. You're both the buyer and the seller. Our solicitor was a bloody nightmare, and it wasn't Brabners, because they were working abroad in France. And I wouldn't recommend working with someone who wasn't in this country, because it slowed down the process. But it could take probably a couple of months post clearance, I reckon, to complete a transaction. If you're doing this in a hurry, though, question: are you doing it for the right reasons, guys?
And Stephen, you've obviously got a lot of experience with clients.
It depends. Yeah, it does depend on what stage they're at in their own planning. So for a client that is completely on board, they've gone through the thought processes themselves, they're fully committed to doing it. If they have a valuation already ready to go, then I would say 3 months is a transaction period. But that planning might take longer, the evaluation might take longer, so that could easily double that.
Sure,
but it's not years. It's not years. But yeah.
The next one's direct to you, Phil. What approaches would you suggest for developing the involvement and buy-in of all employees within an EOT based on your first year? What worked well and what didn't work so well?
Gosh, we had the advantage of being very open to begin with. So assuming that you were not as transparent prior to the sale, I would be looking to develop their understanding of basic financial information, because if you want them to think like owners, I think sharing the financial data is part of that. I would be running events, encouraging people not just to be on the employee council, but go to EOA events. There are various networking events. There's some great online materials. We ran something last week, which one of the managers hosted, on a more strategic option, something that maybe the board or the senior management team might have done before, but we involved every employee in groups to look at strategy and direction on a certain area. And whilst it was potentially very challenging, the engagement levels were fantastic. So it's doing those kind of things, and also organising some social stuff. We have always done that at Boardmans. We give them a budget as an employee council to spend on training, fun stuff, and generally involving as many people as possible.
Thank you, Phil. And I've picked out another question related to this. So what were the main concerns from the employees when the business became employee-owned?
In our case, when the MD was leaving more or less at the same time as the transaction happening, it's going, crikey, what's up with the business? Is it? And what I didn't say is we also have a Chinese entity as part of our group. And in China, they do not get the idea that someone is going to sell their business in their way. So it's like they were terrified that the business was going down and I was running away. It's taken quite a long time to show them I haven't run away. I'm still here over 12 months later, but over communicating that side of it. Other concerns were what changes would people see to themselves? Would they become responsible for more things that they weren't before? Did they perhaps need to make decisions that they didn't have to have? And also, would information that's previously, despite us being transparent, was private information, would they have access to information just because they were owners? And of course, the difference between the broader beneficial ownership and the actual ownership, there's a lot that doesn't change from a regular business. So questions like that, Ollie.
Right. Thank you, Phil. And one final question from the floor was, have you any examples of a business that was 100% employee owned, but then they've changed that over time, not to accommodate management incentives? I can just give an example of, you can change the structure. You might, a percentage of shares might be sold off for maybe equity that might be brought into the business for a particular purpose of growth. But Stephen, Mike, Phil, aware of any examples where the business has been 100% EOT and that's changed?
If you're excluding EMI share options, then I can't think of any, if I'm being honest. It's not, I can't just think of it. It's not a model which attracts traditional venture capitalists or private equity, unless they have a particular proposal that is suitable for an employee-owned business. So I can't, not any that we work with.
Thank you. And there is one final question which I can respond to. Can we get a copy of this webinar? Yes, you can. It'll be sent to you all afterwards as well. So I'd just like to thank Stephen, Philip, Mike. Appreciate your presentations. Appreciate you taking the time to answer these questions as well. So what we're going to do now is move into that virtual lounge that I've been talking about. So each of our guests plus Amy from Boardman are going to be hosting a table, as well with members of the EOA team. So you'll automatically go into that virtual lounge. Please do feel free to visit the tables, and it's okay to leave one as well. It's not rude. Ask the questions, take part in the discussion, and then we'll come back together again afterwards as well. So we'll see you in the virtual lounge. Hi, everybody. Firstly, apologies for interrupting your conversations. I hope you found that very helpful, continuing to speak to Philip, Stephen, Mike, and also one another. Hopefully, that certainly was on my table, a lot of sharing of experience and insight, which was helpful to the people there. So this is just me saying thank you. Thank you to Stephen, to Mike, and to Philip for taking the time to take part in this webinar today. We naturally hope that you found it very interesting, informative, and it's stimulated, hopefully, a lot more questions for you about, is my business potentially becoming employee owned? Or if you're further on the line and it's already going to be happening, it's okay, what happens next? What's that journey going to look like for me? The EOA is here to help. As I've mentioned, we're a membership organisation. We'd be delighted for anybody that isn't a member of ours to join us. We'll be in contact with you. One of the questions has been, will this webinar be recorded and shared? Yes, the presentations have been recorded, and yes, we will be sharing it with everybody who has booked to attend. So once again, I hope you found it very helpful and informative. Please do take 2 minutes to tell us that within the feedback that you'll receive, and it's very much appreciated. And I hope you enjoy the rest of your afternoon. Thank you, everybody. Goodbye.